Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. The topic today is debt funds, and to answer all the issues related with it is a CEO of Value Research, Dhirendra Kumar. Dhiren, we welcome you.
Thank you.
There's been great turmoil in the market because of the debt funds. What should an investor do? How would you define the situation? And should one have it in the portfolio? These are some of the questions that keep coming up. So let's go one by one. What's your opinion on the way the debt funds are behaving these days?
Yes, there has been some surprise on debt fund, and understandable. We have discussed in previous episodes of this hangout sessions, and this will happen. One has to really understand the sense of, one should have a sense of magnitude, the scale. When something hits a headline of economic times, we think that, okay, the world is crumbling. It is not so. The scale of problem is small. Okay. Of course, that scale of problem might be small, but it could be an investor's 100% money invested in the fund, and even that small problem might have a very disproportionate impact on his savings or investments. But let's look at the inevitability of debt. One is that you need to put your money in fixed income, simply because it is relatively much safer. Perceived safety as well as safety by design. Markets can go crazy about equities, not in fixed income. Fixed income, you have three things. How good is the company? Will it repay your principal and interest? And that instrument carries a interest rate, and it has a defined tenure. So all the problem in fixed income will get over in a defined period. Now we have had this problem, but inevitability of fixed income, you need it. You need fixed income. You need debt for two reasons. One is that it provides stability to your investments. So, and it must be embedded as any allocation. We keep talking about it. We tell investors that even if you are investing in equity, start with a balanced fund, because 35% debt allocation in a balanced fund will provide you stability. If you're looking for income, look at equity income fund, so that 35% equity will ensure that it has the potential to match inflation or beat inflation better, but 65% will provide you reasonable stability. So one is that you need debt for stability. The other is that for predictable goals, for investing for 2 years, 3 years, 4 years and when you need the money in foreseeable future, that money has to be in fixed income. Now the fixed income funds are of various kinds, but before fixed income, most Indian investors are fixed depositors. That is a debt. That is the first level of debt. Your PPF account is a debt, is a debt investment, which you lend it to the government, or the post office MIP, which is another popular thing. So if you look at this will be this is the mainstay of Indian savers. This is where they invest. And the problem of all these fixed income yielding, government backed or deposits is that they don't give you the tax efficiency. They are not liquid, and also they are reasonably safe. A good number of them are very safe. But the moment you venture into a territory where you are trying to look for higher fixed income return, you get into a very sticky territory. Your principal and interest repayment could be at stake. Lower rated investment, we have seen it with fixed deposits of many companies. They just go bankrupt, and you don't have access to your money, and all that lending is all your the money which was invested was unsecured. So in that sense, mutual fund still is they get you the tax efficiency. It is liquid. And then comes which one to get into. I think investors need to really narrowly define what they will not be investing in, because that is the way to approach it. Be extremely cautious of it. You need fixed income funds. You need to invest in debt. Okay. But this crisis should not be a opportunity to avoid it altogether.
Okay, what I hear and what I decipher is that don't throw your debt funds out of the window.
Absolutely.
So you need to have them.
It's useful.
It's useful.
Important.
But for what reasons? For What reasons? Of course, you mentioned about the
Yeah.
fixed deposits,
Liquidity.
liquidity,
Tax
and
efficiency.
favorable taxation, and also diversification, and higher return.
Higher return. So these are good enough reason. And such situations like no return on your 2-year investment, 3-year investment should not create a situation that you avoid a good thing altogether forever.
So, how does an investor go about it? How does one invest in debt funds in a given scenario? Are there ways in which one should?
Yes,
First
absolutely.
and foremost, I think one should understand what the problem is, understand what the risk is.
Absolutely. But it is very important to understand the risk of the debt funds. And most investors, they get carried by, once again, the perpetual problem that we are chasing past performance, what has done very well or extraordinarily well in recent past. We try to ride it. And that is where you assume a risk. And particularly fixed income funds, they turn around when you least expect it. I have seen it in the last 15 years, ever since the gilt funds were created, the long-term gilt funds. They are the set of funds which, if interest rates are going to go down, then those funds appreciate very handsomely.
Okay.
Because only the government securities are available with long maturity dates. So, longer the maturity, interest rates goes down by 1%, 2%, they can potentially go up by 4%, 5% if it's a 15-year, 20-year bond. Okay. So for those kind of gains, and when an investor sees those recent performance as 15%, 12% return, they invest, and then inevitably we see that the tide has turned, the interest rates outlook has changed, and then they are hit with a loss. Don't chase recent past performance, rule 1. The other is that don't get into any of the exotic things. Liquidity is very crucial. Your ability to take your money back anytime with fixed income. So with that, there are 16 kinds. This industry has, also gone about complicating. For understandable reason, a large sales force has to be in the market, and, they try and craft products which are very specialized. In fact, now SEBI has defined 16 kind of fixed income funds. It's very hard for me to explain
16
it
is too
16 is 16
many.
are too many. Besides 16, you have FMPs. Besides 16, you have many kind of hybrid which are dominantly fixed income. So there are 16 kind of open-end debt funds. Most investors should give it a pass. Most of them. For most investors, 4 kind of funds are useful, and look at them very closely. Money for few days and few weeks, liquid fund and money market fund, they are good enough. Don't look at, because you get little more than your short-term deposit rates, substantially more than your savings bank account, and it operates almost like that. Get your money back anytime, and there's no exit load even for an overnight investment, and take your money back anytime, and reasonably safe. We haven't seen, except for one liquid fund, which faced a decline in value. We haven't seen otherwise generally. Okay. They have generally done well, and you get little more return than your savings bank and short-term deposit rate, and money is absolutely liquid. Take your money back anytime.
So what you're saying
money
is
for few months. Okay. Consider ultra short-term bond funds and short-term funds, and that is it. These 4 kind of funds should fulfill all your needs, because what we have seen is that most investors try to look at slightly higher return on capital, and they put their capital at stake, which is a very undesirable thing. Fixed income investors, their primary concern should be that capital should be absolutely safe or reasonably safe. In mutual fund, it cannot
and
be
on top of
absolutely.
that, if you get something,
yeah, you always
that's
get
good.
little more.
Yeah.
But having consistently, a high quality portfolio, and in case of fixed income fund, I would say that the rule should be never invest in the best performing fund, because if the best performing fund, the outlier on the higher side, will always be assuming some risk which is not visible. So maybe if you're looking at 1-year return, 3-year return, knock the one which is top 3 funds, knock them. Don't invest in them, simply because there will be a risk which is not visible, because risk visits you once in a while, and returns might get impressive continually. So that's a very naive rule. It might sound very unusual, but follow this and you will be saved of the nasty surprises.
So don't even look at the top 3, and don't go beyond the liquid, ultra short and short duration category.
Short funds. Yeah.
Don't go beyond that.
Yes.
Then you're safe.
then you are reasonably safe and you have access to your money anytime.
Okay, what are the circumstances which an investor should avoid or not should avoid taking a risk? How do they decide which money to invest in debt fund or not?
No, as I said that these 3-4 kind of funds are appropriate for even your critical money. But don't try to, because unless it must be worthwhile, it must be relevant. Assuming that, your money is idle for just a month period, and so you have option that the money lies in your bank account and you will earn 4% or 3.5% in state bank on your savings bank account. If you put that money in a liquid fund, you might make 6.5, 7, or it can well go up to 8% as it has happened in the last 1 or 2 years. Now this differential of 3.5 or 4% to 8% for 1 month will be how much? If it's a lakh of rupees, then and for a full year you earn 4,000 rupees more. So for 1 month it will be 4,000 over 12. Yes. So for 480 rupees extra, something like that.
Putting your base amount.
Why do it? So just see if it is worthwhile. If it is 50 lakh rupees, the money with which you will buy a house, and you are on your house hunting, or you are on the lookout, and the down payment, maybe that money could be lying there for 2-3 months. Maybe put that money in ultra short term bond funds. Avoid the top 1 or 2, 3, because the best performing, top 2 or 3 by return in recent times. Because avoiding the best performing ones, I think will always save you from the inordinate risk which some funds might.
I must say, I find that very intriguing, that mantra that you're giving, avoid the top 3 returning funds.
Yes.
So,
because what I found
is
that
you to elaborate a bit more on that, if possible.
Return comes with risk, and this is something which one should.
Yes.
And your primary goal should be to avoid the risk.
Okay. So understand the risk first, and is it worth getting a few rupees more for and jeopardizing your main amount of money? Think about it, and then decide.
It's also, one has to look at it that that little extra return will not make a huge difference to your life. But exactly. if you are hit by that risk, it will be a breaking point. Yes. So if you hit it off, you don't make something meaningful. So the trade-off is just not worthwhile.
So hope you understand that. Avoid the top 3 funds that give you the return when you are into the debt category.